Hello traders, Gary Wagner here, just about 11 o'clock in Honolulu, 5 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It is the last trading day of May 30th, 2014, and this is the daily report for gold and silver, our weekend review, and what a week we've seen. Dramatic sell-off as we witness gold selling in double digits at the beginning of the week, and basically follow through or lower consistent pricing ever since that point. Today's trade activity is bringing the market down below 1250, current print 1249.26, the low 42.10, the high 1260. Traders were off roughly $7 on the day. Not wanting to feel isolated, silver is following in suit, with gold currently off about 23 cents or 1.21% lower on the day, as opposed to gold, which is down about 0.5% on the day. Low 18.55, high 19.19. Current print below $19 per ounce at 18.80. We'll talk about silver towards the end of the show. Traders, I'm sure you're familiar with the adage, be careful what you wish for. And that's certainly what we saw this week, because what most traders were wishing for, more than anything else, gold traders and investors, was the fact that we had been trading in this narrowly defined trading range, about a $30 range, that had really been the overall characteristics of gold pricing in the gold market over the last 4 or 5 weeks. This market has been lackluster, to say the least. On the high side, we started to get a series of lower highs. You can see these highs right up here. They're about 1305. Let's go ahead and compress the chart a little bit. And when we do that, you'll see these series of highs as they came in on a 60-minute chart. Of course, as I said, very short term. First, we had really 1315. Market comes down. This is the low just prior to that. Retests this low at 1275. Moves back up. You've got a 1300 print and about a 1305. Call it 1305, 1305, 1304. So you had these series of highs that were either very close to each other or going lower. And you'll really see this, of course, on a daily or a 360-minute chart. But you also got a series of higher lows. It's not compressed, but if you take a look at, for example, this low, and then these subsequent lows here, you did get a series of higher lows. And so really what that formed was that pennant formation wedge. I like to call it a compression triangle because that eloquently describes what I believe is going on within the mechanics of the market itself. Then, of course, when that market broke, we had the dramatic sell-off. Since that sell-off, it has been hard-pressed to find any kind of support. You can see this little clip up here before heading lower, and then off of the lows here, what did we say, roughly at around just above 1240, now trading 1248, 1249, so just off of the lows here. But you can see a couple of very small clips to the upside as this market, for the most part, has been in a downward spiral starting at the beginning of this week. And really nowhere does it become more apparent than taking a look at a short-term chart, Japanese average format, 360-minute. We've drawn a couple of areas that we believe to be of critical importance. First of all, our upper level resistance line, and this is that series of lower highs that I'm speaking about. You can see that here. We sent out a link to the chart, and of course, we've been talking about this for the last couple of days since we've had this break. We were talking about it prior, but it was almost like I felt it was the boy that cried wolf, in that we kept looking for a dynamic break. I was hoping for a break to the upside. Of course, we didn't get that. We got a break to the downside, but we were looking for a break, a release of energy, and a pretty sizable move in the marketplace. Well, we got that. And really, when we look at this chart, I want to take a look at it in this way and in candlestick format. What you get in candlestick format, the only real difference, of course, is we're looking at true opens and closes as opposed to comparing each candle to the midpoint. So let's go ahead and remove that and just look at the market through the eyes of a standard candlestick chart. I've also got a 30-day moving average, and you can see that Interestingly enough, as the market was trading sideways, it was really trading just above or just below that 30-day moving average. Obviously, when we had this very, very sharp spike and move to the downside, of course, that left this moving average kind of in the dust as we saw lower pricing, and the average, of course, will never keep up to the flowing price as that changes. That's what makes an average an average. The critical thing, as far as I'm concerned, and we talked about this, is the fact that we have now closed, in essence, for the week and closed below the 61% retracement of this rally. And when we look at this rally, we had a dynamic move, 1180 up to 1391. So a little over $200 move. We've given back now about $120 or 61% plus. Market trading at 49. And as I've been speaking about to our daily subscribers, and we talked about a little bit on Chart This, really, in my opinion, right now, the market really has nowhere to go but around 1232. That, to me, is the most critical number. It's a 76% retracement level, but we also get this number when we look at some of our longer-term fib retracement points. And here's what I'm speaking about. I've pulled up a weekly chart, standard candlestick format, which is really irrelevant. We've compressed it so tightly we're not really looking at candle color or candle patterns. Rather, we're looking at a multitude of different fib retracements. You can see this green line where it says 100. That is always your starting point. That starting point is going to give you this set of numbers here. This starting point here is going to give you this set of numbers here. All of them start at the various green lines that have 100. All of them end at this 0 point. And that's how we get these different time cycles and price cycles across the board in gold. Now, when we do this, and the reason for creating this chart, as you're well aware of, is what I'm really looking for is what I term fib harmonics. And when I say I term fib harmonics, there is a definition of Fibonacci harmonics which is different than the one that I am utilizing or expressing, because the harmonics I'm looking for is using multiple time cycles, price cycles, and coming up with key price points that have a combination of two or more a different retracement sequence. So for example, you've got a 50%, a 61, and a 76% retracement when you look at this, and this. These are the three that you're looking at right in here. Now, when we do that, we talked about the importance of 1292 to 1295. That's based upon a 50% retracement right in here, and it's a 51% retracement of the move from, call it 572 up to the top, 50% down. Now the key is this, or excuse me, 50% down, ends right here. Once we broke through there, and that was a critical number to me, we then looked at how it was going to react at 62. We just showed you why that number was important, but the next number that comes in is a 50% retracement, and it is a 50% retracement of a fairly sizable move, because the move that we're looking at, again, as I said, just below 600 up to 1900, 50% retracement. Now, the next level below that has a triple harmonic. So to me, this is the most critical number that we have. 1141, 1146, and I believe 1149. The key is this: when this market broke and came down with a vengeance, and it's been doing that for well over a year now, it hit this double bottom. There's our first low, there's our second low. Both lows were above this 61, 50% retracement level. The fact that we get these harmonics right here, in other words, we have three different time cycles, all pointing to the same area, one. Secondly, the fact that we have seen this area hold in terms of a supportive parameter, meaning each of these lows were above this area. 1141, the lows were around 1180, so just $40 off of these areas. This is a critical area, and this, to me, traders, is really the most current dramatic line in the sand. And what I mean by line in the sand is as follows: a break and trade below this area for the first time would actually be signaling the fact that there's no possible model that we can think of that would call this a corrective action within a bull market that's going to go back into a bullish mode. We know that we've been in a bear market. There's no doubt about that. We know that the cycle and the price action has been down. However, we also are aware of the fact that when markets move up and down, they tend to stair step. So logically, you've got a series of rallies followed by corrections, rallied followed by corrections, rallied followed by corrections. That's typically, in terms of an Elliott wave standard, that's the impulse phase. Your corrective phase is really a series of waves in which you give up a percentage of this move, and that percentage should not exceed 61%. And so when we look at this move and we look at the fact that a move dramatically below this point or to this point, meaning 41 to 49, 1141 to 49, a new low in the market, and below a 50% on the longest of cycles and a 61% on the shorter of cycles, really tells us that we have gone from an extremely bullish market to an extremely bearish market. Any rallies we are experiencing are counter trends to the upside moves, as opposed to in a bullish market, your corrective action to the downside is a counter trend, but the market is still in a bullish mode. It's just retracing. We will not be able to say that if we breach that point. And that's why, traders, that's so very, very important. The other thing that is critical in my eyes, and this is a very, very broad look at a Elliott wave count, I really think that we have had a difficult reading market of late in terms of deriving any kind of solid count. But if we are to make the assumption that this correction terminated at the second of these double bottoms and we then entered some sort of an impulse phase, well, we got the first piece of technical evidence that confirms it, and that was that rally that propelled this market from 1181 up to 1391. However, if this market continues to drop and we're now past that 61% retracement, if we go past 76%, we cannot in any way still look at this model as any kind of an impulse phase. Rather, it's a continuation of the downtrend that literally began as the market broke for the last time at $18 per ounce. Because when you consider we hit this all-time record top, we then hit top number 118, top number 218. This is that top number 3. We had this flat bottom, which had these lows at about 1535 that held 1535 to 1800. So we see after the market hits this new record top, we have the market literally oscillating between these price points of 1800 on the upside, 1500 on the downside, until we had this dramatic fall. And in fact, I remember it was the point in which it broke through 1535 that we realized that a waterfall was about to open, just in terms of price change and momentum in the market. And my belief is that these are the types of areas that we look at and we see these kinds of dramatic breaks. We could be on the doorstep of that kind of a break, because traders, if it continues to trade lower, trading at 48.49, if it cannot hold the level we spoke about, 1232, the next real level that it could go to and test is going to be first this double bottom, 1181, and then 1141, which is at 50 and 61% retracement level. If it breaks that, it's breaking really a long-term rally, which propelled gold to 1900 plus per ounce. So there's no doubt this week has been a game changer in the market, just in terms of how the technicals look. Now, because of that, I will be working this weekend on a special report. I'm titling it Gold in Crisis, in which I have had some time to analyze this recent price action, and I want that to be available to all my subscribers and viewers before the markets open on Monday. So that will go live and get published by Sunday. I hope to have it finished by Saturday. In either case, you will receive an email notification when that special report is completed and published, gone live on the air, so to speak. We'll send you out an email so that you can view it as something that you have in your arsenal prior to trading on Monday. So traders, of all the different technical indicators that we have been using over the last few months, and you realize that when we look at technical indicators, we're using some that are quite different than the norm. I will use moving averages, of course, but I'm not using a lot of the traditional Western technical indicators. Rather, I am using candlesticks, candlestick patterns, Japanese average charts, because I think that they really give you a visual perspective you can't get looking at a bar chart or the patterns that go with that bar chart. That being said, the Andrews Pitchfork is a very powerful Western tool. We have had this chart for quite some time, and the one thing that we can say is that we were absolutely faked out when it did actually breach above that in trading. However, since that point, it has come down. It has tested and held, at least this first time, a 23% retracement, moves back up almost, 2/3 of the way up, comes back down, and this is where we had that sideways trading action, and this is where we had the spike down. Looking at it under that context, it's quite obvious to me that really where it's going to head and rest, at least for a first moment, is it's going to come back to test this 23% cascading retracement line. Does it going to test it, move up, or is it going to test it and continue downward? The one thing that we can say about this chart is we are absolutely categorically 100% still within a bearish scenario. We've been in a bearish scenario. All of these rallies that we've seen, and we've seen some considerable rallies, although the frequency hasn't been that grandiose, but they've been considerable in terms of size move, a couple of $100 each time, but they have been counter trends to this overall dynamic bearish scenario that we're seeing. The bears are absolutely in control of the market right now. There's no doubt about that. So we're looking at silver. My daily viewers know more than anything how bearish I have been on the precious white metal. I really felt it had nowhere to go but lower. We can see that now it's roughly, call it 1870, so it's gone to test these lows down here that we spoke about yesterday. And once, or if those lows are breached, we really have to take a different type of look at the market, meaning a much longer term look in silver. So to do that, I have taken a daily chart and really compressed it down to a 3-day chart so we could look at a couple of key areas in the market, because up until this point, we really haven't had any kind of a dramatic potential that we would breach a certain area. That area is right in here in the low 18s, because consider this. 1987, pretty critical point. That's these series of tops here. And the reason you can say they're so dramatic is they come right prior to this parabolic move to 50. Second time the market's done that, first time in the 70s. Market crashes hard, there's no doubt. But you can see a series of bottoms that formed in the market roughly in the area where silver's trading right now, these lows. And these lows, if we take a look at how they line up, they are below this critical support area. And in fact, because this area, of course, has been breached, and so is 1958, those were really important numbers. But if these lower numbers get breached and we take a look at where we could find support, we really get hard pressed in terms of areas, in terms of historical perspectives, and we really get into a nebulous area. Because if you look at how the market reacted, and let's go across this so we can see the points in time in which it was trading within the range of 18 on the high, 15 on the low. It's been all over the board. We see really strong support here. We don't really get, or resistance here, resistance here. Our levels of support, well, we have some strong support at just below 15, no big deal. We have another area right in here that is in the low 18s, high 17 areas, and that's right here. So historically speaking, if this market continues under pressure, silver could experience a dramatic price decline along with gold. Thought for the weekend. This has been Gary Wagner, wishing you as always good trading. Have a great weekend. We'll come out with the special report this weekend, so you have it for Monday, and then we'll talk to you on Monday for another daily update and review. Bye-bye.